people are very anxious right now. There's also a lot of reasons that people are very ecstatic right now. How can they exist simultaneously? I think it's 21 record highs this year for the stock market. At the same time, consumer sentiment is one of the lowest that it's been in a long time. I personally value less having a large, untouchable future amount of capital than I do having a consistent and guaranteed and steadily increasing floor of monthly cash flow that I know is going to be coming in when I hit those later years. If I can generate a system that brings me, say, $20,000 a month of passive cash flow, why do I need to worry about what my retirement account can be at 65? All right. Hey, welcome back to Remnant Finance Podcast. We've got a solo one this week. Been having a few guests lately, which has been great. There was a chance that we were going to have a special guest on. Brian was hoping to hop on, but he got put on the flight schedule tomorrow to drop some more freedom. And so we are waiting for any news on when he might be coming back. But in the meantime, you are stuck with me. We've got some interesting interviews coming up still. I want to talk again with Ro. Those have been phenomenally popular episodes, at least by our standards, because it is a unique application of what we talk about regularly, but in a different world, i.e. the cash balance plans for business owners with tax problems, which is all business owners. And then also the estate tax side of things that we talked about, the estate planning side of things, the documents that you need. That's just something that's so overlooked. And I think that I can't recall ever talking to a client where the estate planning side of things is buttoned up with no issues, and everyone needs this. Even if you could have no assets, living paycheck to paycheck, and you still need these documents because of just the medical directive elements alone. What you want to happen if you were incapacitated, et cetera. But if you have any kind of assets, you're going to be leaving your family with a mess, even if you're not above that $30 million for a married couple estate tax threshold. So estate planning is not just for the wealthy, and I hope you took that away from the episode with Ro. But what I want to do today is I want to cover just a few kind of some thoughts on what the headlines that I'm seeing are, because I'm getting the same questions, and I think that everyone's getting the same questions because we all are looking at generally the same data and the same spectrum of headlines and how they're interpreting these things. And there's a lot of reasons that people are very anxious right now. There's also a lot of reasons that people are very ecstatic right now. How can they exist simultaneously? That we are just, I think it's 21 record highs this year for the stock market. At the same time, consumer sentiment is one of the lowest that it's been in a long time. And so how can people feel nervous while the market's at an all-time high? And I think there are some very important things to look out for here. And I think a lot of stuff has changed even in the last couple of weeks as far as the expectations from the Fed, et cetera. And so I'll talk a little bit through just to give you a few of my thoughts on that. And then I want to, part of doing these solo episodes, now that our platform is a little larger than it was, it's still a small platform, but larger than it was when we first started putting out episodes. And one of the concepts that we kind of talk about, we reference it like someone listening knows what we're talking about, is the average rate of return fallacy. And that is kind of in my experience, the holy grail of financial planning right now seems to be relying on historical data to take an average that is then projected into the future. And I want to make the case, and we've made the case in the past pretty early on in the podcast, that is, in my mind, essentially a meaningless metric. And so I want to use both just kind of thinking logically through that, and also put some numbers on it to make it clear. And we're gonna do it pretty simply, because I just don't think that that's something that you should really even be thinking about at all, honestly. And when we talk about financial strategy in the way that we do, I personally have this feeling as we're watching the market over and over and over. I think that it's very easy to think I'm missing the boat by simply not being maxed out in equities. And I don't contribute to retirement plans personally. Now, I could have large retirement accounts right now, or large relative to what they would have been, say, 5 years ago, and there would certainly be value there. But I personally value less having a large, untouchable future amount of capital than I do having a consistent and guaranteed and steadily increasing floor of monthly cash flow that I know is going to be coming in when I hit those later years. Now, I don't intend to retire in this sense, but I like the idea of work optional. I like the idea that I can do this job because I truly enjoy working and studying whole life and getting policies for people to implement this process. And when we look at the dividend features of these policies and what they can do in later years, especially if you're in our general age, really anyone from like mid 20s to mid 40s, we have a pretty long runway ahead where even if we're using that 65 kind of standard metric of retirement, where you can build an enormous cash flow engine through your policy if you want to. And again, I'm not going to for compliance say that that's exactly what it is, but if you understand how to use this and you understand what you can do with dividends, I mean, that's a very viable cash flow supplement down the road, presuming that you put the capital in now and build it up front. And so I don't necessarily, personally don't like the idea of, okay, cool, I got close to 30 more years till I can touch those retirement accounts. I mean, I guess I'm being generous, more like 20 years, 22 years almost, turning 38 next week. And so I got some time until 60, but I can do a lot in the meantime. And I think I can outperform what those accounts would do had they just been left unchecked to grow for the next 20 plus years. And even if they are a higher value number, it just the idea that they don't contribute to my life meaningfully at all right now, I don't want to be relying on those. Now I do invest, I do buy equities, I do a lot of primarily options trading, but part of the strategy that we use, I do end up with quite a few shares that I'm holding on to. And my goal ultimately is to get rid of those shares after I've made money on that to recoup both my cost basis and get up to the recovery price. That gets a little more into the weeds on what we're doing. But I feel very comfortable with the income strategy that we're using out from our option strategy to continue to grow the balance of that portfolio. By the time I'm 65, my trading portfolio, I believe, will be much larger than had I just invested in the S&P 500, for instance. I believe that will be much larger than what it could have been. And so all that to say, if you feel like you're missing the boat because you're not in retirement plans, and I know a lot of our clients aren't, because just philosophically, like, this doesn't resonate with me. It doesn't, I don't think it resonates for Brian. I know it doesn't. And a lot of people that we talk to are just like, I just don't see the value in doing that anymore. But if you feel like you're missing the boat, if you are, we still need to invest and grow, and we need to be making those returns. But I think there's a lot of really good assets that we can use now that can kind of, you don't need to have that FOMO. As long as you are conscious of what you're trying to do and where you're trying to get to, it's just as equally valid to set a plan like Joe Witherow's target at the Phoenician League, building a passive guaranteed $10,000 a month cash flow to start. Like, and that's a plan that he helps you get to. And you know, within about 5 years, give or take, you can pretty reliably get to that point. And so once you have that as your floor, you now have a lifetime of cash flow put in place that you can free up these decisions now and make changes now. And if you continue to grow that floor, what does it really matter what your 401k balance is when you have a guaranteed X tens of thousands of dollars a month that are coming in on a passive cash flow side? Of course, that's a very greatly simplifying things, but if I can generate a system that brings me, say, $20,000 a month of passive cash flow, why do I need to worry about what my retirement account could be at 65? That's conceptually how I look at it. But what I really want to do is dismantle the average rate of return fallacy in this discussion. You can go back to the early, probably 15 or so, episode 15, something like that. This will be, I believe, 102 that we're out. Pretty happy that for that less than 2% of podcasts ever make it to 100. So we're very happy that you're sticking with us, and our channel is growing, which is great. If you are seeing those ads on there, I apologize. You need a certain amount of followers on your, at least on YouTube, to be able to kind of call your own shot as far as advertisement goes. We have enough views and enough view hours that we get advertisements. We just don't get to control them. And so that's really frustrating, that people have to deal with that. And we apologize for that. That's not us trying to, sell you, like, male vitality pills or something, whatever pops up on YouTube algorithm. That is just the fact that there is enough viewers that we do merit ads. We just don't get to control them yet. So, and as an ask, if you can share this, and people that do subscribe, once we hit that number, we can at least tailor that and control what is getting put on these videos. So anyways, a little aside there, but just a couple of things, that the headlines that we're seeing. Is AI a bubble? That's the constant. That's probably the number one question right now. And so the best explanation I've heard from that is from David Bahnsen of the Bahnsen Group. And he has a daily podcast and a weekly newsletter called the Dividend Cafe, which I think is really great, balanced economic insight. And his take was basically, is AI a bubble? Well, yes and no, but there's different types. There's bubbles where there's underlying value, and there's bubbles where there's not. So, for instance, the classic example, the tulip bubble, which I think is drastically overblown. If you like read more about the tulip bubble and what it actually was and who was actually impacted, it was a small subset of the Dutch economy actually participating in it. It wasn't this just earth shattering thing. It was like people speculated and lost their speculation. But just take it for the story that it is. Let's just pretend that it is what we're told, which is that the entire country gets swept up in this mania and then everyone just loses their fortune. I think that happened on a very small scale to some people, like to a subset of society that was able to invest in something like tulips, which is just sounds preposterous. But I don't think it was. I just don't think it was as advertised as we're taught. But we'll just take it at face value that you have something as preposterous as a tulip bulb, which is, a living organism, which is going to die. And just the fact that, if we take this idea that insane valuations on something that we know with certainty will not merit, or there's no underlying value that pays it off. Well, yeah, that is absolutely is a bubble. So something like NFTs, right? NFT as a use case, if you understand what it is, as far as actually digitally cataloging items, right? And so that's how you could have, certificates of ownership. And so I think that gets into along the lines of stablecoin and proof of ownership. There's definitely a use case for NFT, but not in the speculative, this is just a picture of a Pokemon card and someone bought it for $10,000 and I'm going to try to flip it or whatever. Like that's stupid, right? That's just gambling. And I'm a gambler. I love gambling too. So I mean, it's not tethered in reality of valuation, right? But then let's take like the .com bubble. Of course, the classic pets.com, where you just have a business and slap .com on it, and people start just paying out the nose, and the valuation goes through the roof, and then it crashes. Well, there's also David Bahnsen also made the case that there's also a ton of companies that were absorbed in the .com bust or swell and then the crash, but actually had underlying value, something like Amazon, or a company that gets swept up, gets that overvalue, and you say, is this .com thing a bubble? Well, yes and no. Like eventually a lot of the companies that merited that valuation proved it, and it ended up not being a bubble for those companies. But as a whole, yeah, we kind of call that era a bubble. And so today, the case he made was, there's a lot of companies that are going to continue and merit these valuations, and then they're going to continue to produce. Now, on the positive side of that, as in the side of the value, the companies with actual value that are swept up in this mania, but at the same time is also justified to some degree. It justifies certainly more to the crash that ensues. You're going to have companies like, the reason the stock market is all-time high is because a small sliver at the top of the S&P 500, these large cap companies, the hyperscalers, the tech companies that are going all in on AI. Well, what does it mean when you go all in on AI? What I'm going to walk through today is this little slide deck, and just as a kind of a little example here, if you go back 2 years or whatever to when we did our average rate of return fallacy video. It's one of the shorter ones for us, 25 minutes or so. I also did a YouTube video, and I spent a lot of time working on this PowerPoint presentation where I made the cases, and I used the numbers. I wanted to make this visual. I remember sitting in my living room in Texas with my folks, working on these slides, and I remember like kind of telling my mom, "Hey, can I run this by you? This sequence of this logical sequence to make this point. Pretend you don't know anything. How does this come across?" I remember specifically doing that. I remember spending a long time on this, and at the time, I had quite a lot of time because I was living in Kingsville, Texas, on an IA, which is basically a kind of a one-off assignment, because I wasn't allowed to fly because I was not safe for not trusting the science, and so I spent I got 6-month orders, but it ended up being like 2 months. Where I had no job in Kingsville, Texas, and I basically just sat in a hotel room working and learning. And it was about 3 hours from home in San Antonio, so I spent on the weekends back at my folks' house. And I just remember spending a ton of time on this PowerPoint slide. Also, some of my articles that I wrote for our blog, I had these ideas of what the images should be, and I made some things in PowerPoint, and I made my copies. And then I used Fiverr.com to outsource this and say, hey, I need an actual someone who can do graphical representation of this data, or take these drawings that I did, just make them look better, right? And I paid someone, whatever it was, $100-200, someone in Pakistan to make these things, and I don't think they turned out very well, but I used them because it's better than what I did. Well, I pulled those up today or yesterday. I pulled up that old PowerPoint video, or that old PowerPoint slide deck that I made. I pulled up some images that I made myself or that I had paid someone else to make. And I said, hey, I fed them all into Gemini and like the Notebook LM, right? And I just said, hey, make me a slide deck based on this. And it's way, way better, right? So if we think about that, if you're a company, if I'm a company, Remnant Finance, if I can shave a lot of costs, i.e., these are one-off situations, but let's just say that we do this all the time, and I'm paying a ton of people in Pakistan to design these things, and now for like a business subscription to Google, it's like $12 a month or something. I can have all of this done immediately. I mean, it just took probably took a minute, which felt long. I'm like, why is this taking so long? Why is it taking a whole minute for AI to create me this PowerPoint slide? It should be like 2 seconds, right? That's how spoiled we've become with this. And so this slide deck here is kind of representational of it helps me understand why these companies are shattering record profits right now. It's because they're all laying off tens of thousands of employees at the same time that their company profit is going through the roof, right? Because a lot of us are using AI to trade, right? And so if your trading decisions can get more efficient, if your financial allocation, capital allocation become get more, focused insight, right? And remove a lot of the emotionality, like using AI as a tool, you can make a lot of money with it. And at the same time, if you're shaving off the human cost, the human labor costs, i.e. paying someone a living salary in San Francisco, for instance, if you can shave off 10,000 people getting paid a living salary and substitute their outflow of, or whatever, their production, right, with a couple of monthly subscriptions, it makes sense that your profit margins are going to absolutely explode. And so for the same amount of revenue that you have, even if you keep your revenue exactly the same, but you just very simple math, like if you earn $100,000 and it costs you, like $30,000 to do that, and you shave that cost in half to 15, well, your revenue percent as a profit is going to go off the charts there, right? And so, not off the charts, but I mean, I'm making up the number there, but like you earn $70,000 of profit on $30,000 of investment, right? That, whatever, who cares what the numbers are, but and then you go to 85,000, 70 to 85 percentage wise is a large percentage increase, right? Especially when you're talking about year over year. And so these companies are just shattering earnings reports every time it happens. Like every time a new earnings report comes out, it's like they just blow everything out of the water. It's like they're doing more with less as far as using these tools to generate more dollars. And they're doing, even if it's the same dollars, they're doing it on a greatly reduced cost of labor. So it does make sense. And a lot of these companies are going to survive. Right now, the idea, like the Allbirds, the shoe company that was failing, just became effectively just selling data centers, selling compute. And now their stock doubled, and then it came back down a little bit, but like they're way above what they were. They've just rebranded. And the funniest meme I saw was one of those little free libraries, and it was like my little free data center. So it was a little, outside someone's house, this little library with a swing door open, and it was just a bunch of little like GPU racks there. Or the Spirit Airlines, after their bankruptcy announcement, and it just like the cargo doors of Spirit Airlines were open, and it was just data center, right? And so that's the joke right now of how to revive your business is just sell compute. So there's a lot of companies right now that I don't think are going to survive this shakeout when the valuations actually come home to roost. And the problem is valuation metrics, I think, are being very much shattered because this is breaking the mold of how these companies are valued. How do you value SpaceX? Like this upcoming IPO, by the time this comes out, like we're a week away from them, I think, pricing those shares on June 11th. $1 trillion company, like looking at the revenue of what SpaceX might produce, or looking at the current revenue of Meta, right, of Facebook. I mean, it's prolific amounts of money being made on a shrinking workforce. And so these valuation metrics, just so much is in flux right now. And so much of the modeling and the mechanism behind getting this data is going to fall away, and it's going to have to be replaced. And so you can't, for instance, like they're having so much problem valuing SpaceX because you can't just take what worked for valuing a company like, Staples and just say, here's your cost of good. Like it's the fundamental analysis behind all of this is totally changing, and it has to. Those models can't keep up with this. And so to some degree, to a large degree, a lot of these companies are getting swept up in the hype of this because it's like anything that AI touches right now, anything that compute touches is just turning to gold. But is it actually gold? Because is there actually profits yet? And so there's kind of this like, we're sort of like outrunning the tide coming in almost, where it's like we're ahead of this wave right now. I say we, just like the economy collectively, or more specifically these tech companies. They're like, hey, we're trading on reputation right now. We're trading on expectations. We're trading on future earnings by making these investments now. We're cutting our workforce. We're increasing investment, and revenues are just exploding. Profits are exploding. So how far can they stay ahead of that before at a certain point, when investors want to see, all right, you made the promise, we bought it, but now what do you actually have to show for it? Are you actually producing revenue? So the ones that get washed out of this, I think is going to be brutal for a lot of them. But the ones that are going to last through it, a lot of the, I'm not going to say any stock tickers specifically, but there's a lot of stock tickers that I personally like that I'm trading options on, and I'm very comfortable owning, getting those, assigned those options, right? And I think that we're not. I think we're at the beginning of this wave, honestly, even though it feels like the bottom could fall out at any minute. I think if we take a 10-year view, I think 10 years from now, we'd look back and be like, yeah, clearly these stocks were going to continue to skyrocket and we're earning their valuation. And then a lot of them, of course, Allbirds, whatever, the shoe company, like and I don't know anything about that shoe company other than this business pivot that they've made. But that idea that you just switch to doing anything in the AI realm and now all of a sudden you just get, monster profits. Like, I don't think that's going to last long term when there needs to be some return on this investment. There's the other elements of, people not wanting data centers in their town, right? And so there's town hall meetings and city council meetings where people are cheering when these data centers get blocked. And I think that the counties that want data centers should, they can have them, but like, I don't want them in my town because they're just a sponge for these resources. But at the same time, they're going to bring so much money to your area, and so business is going to play out. Whether you like it or not, business is going to play out, and money is going to incentivize things. Money is a currency; it's an energy that's going to move through the economy. And right now, it's just this tidal wave of energy moving through the economy, and it has to have somewhere to let off the steam. Right? You have so much money pouring into this, and so where it erupts, where it like bubbles to the surface, and just like Old Faithful, it's the stock market. That's what we're seeing right now. I think, again, 21 all-time highs this year. In the month of May, there's like 4 or 5 all-time highs. It could be like 8 or 9, I don't know, but it is a lot of all-time highs every single month this year, as time goes on. And so I made it, even like 2 months ago, I said something along the lines of, hey, how comfortable do you feel that the stock market is going to be higher by the end of the year? I still kind of feel like it's going to be lower. I feel that it should be lower by the end of 2026. But again, I felt like the bottom should have fallen out 5 years ago, and every year since. It just doesn't seem to make sense. And so if you're wrestling with that, I think well, clearly two things are true at the same time. The economic sentiment is very low right now. There's a lot of uncertainty around this preposterous war that we started with seemingly no plan. I mean, even the people I know that are bullish on it, that have been like, yeah, we got to go show Iran or whatever. It's like people are realizing now, I think, at least in people I'm talking to, like, wait, what were they doing? And so anyways, regardless of that, like there is no current solution or win and that I can see in that. I think the best case scenario is we basically just get booted out and leave and claim some kind of victory somewhere. I don't know how, but we find some victory to claim on paper there, and we just get out and call it a loss, like just leave with our tail between our legs. I don't understand what the value proposition is here of continuing to do this. But regardless, what is true is that oil prices are just spiking on the whims of a tweet, and like clearly they're feeding false intel that, oh, we're close to a deal. There's talks, and Iran's in trouble, and then so oil prices drop again, thinking that there's some relief coming, and then Iran's like, we didn't say any of that. Like, we're fine. We're going to outlast you. Iran's already won this war in my mind, and they know what the whole world knows. It's just our intel department is trying to keep this this mirage alive. But like we're watching the market respond in these sharp ups and downs on these news on these news stories that don't ever really seem to ever come to fruition. So all that leads to a general feeling of distrust. Like, hey, is the AI bottom going to fall out? Is oil going to hit that point that people keep citing, like 2 more weeks at this price and things are going to really start breaking? Well, they haven't really started breaking, but of course, prices that we're seeing are still continuing to climb. It's just, it feels, it's hard to see that the markets are at all-time highs while we're kind of feeling the sentiment that we have. And so getting back to the average rate of return, I don't want to I don't want my portfolio. I don't want my future. I don't want my cash flow. I don't want my quote retirement, even though, again, I'm not going to retire. I don't believe in that. But I don't want these decisions that I'm planning for, i.e. building up cash flow so that I can do work optional, work to the degree that I want, et cetera. I don't want those dependent on what the Fed does, right? We're now in a situation where we've had 3 consecutive Fed chairmen who have done this basically continuous QE effectively, basically this the Fed buying the Treasury's balance sheet and propping this thing up. We had Bernanke, Yellen, and Powell continue to do the same playbook, and now Warsh can't do that. Warsh can't come in and cut anymore, and I think he's right to not cut. I don't think he's going to cut, and in fact, there's a higher chance that he's going to raise per the markets than that he's going to cut. And this whole charade of like, oh, you need to cut, you need to eat, the market's like dying to blow off steam here. You're just, why are you holding it back? Well, one, the Fed's rate cuts and rate hikes don't really move the market like they used to because they're severed from what actually matters, i.e. the long term. They're short-term rates, the SOFR rate. They're not affecting the 10-year mortgage. In fact, the Fed could cut right now. I don't think the mortgages would change at all because the bond market is calling the bluff. The long term, the tail end of this yield curve is calling the bluff. They're saying we don't believe you. You can say you're cutting rates, but you can say you think that employment's under control, or we want to increase employment and inflation's under control, so we're going to cut rates. They're like, well, we just don't believe you, so we're not going to act accordingly. And so if that's the case, I don't think Warsh can cut. But again, I don't want whether or not Warsh cuts to affect my strategy here. I do have investments that will in some manner be impacted by that, but I want to minimize my impact of that, and I philosophically want to have a small allocation that's dependent on these forces, right? And so contrasting with the mindset of 80-90% of your capital just needs to be tied up in the market because the long-term market always goes up. Like I don't want that. I want 10-15% in the stock market. I don't want 80%. And so I'm going to just pull up these 2 products that Gemini or whatever, what's it called? Notebook, Google Notebook, LLM, whatever, where I just said, hey, take these products that I made and let's make them better for me. And it did. So let me share this real quick. Share 2 things. First is the slide deck. So this is a nicer, cleaner presentation of the slide deck that I made. And so average rate of return fallacy, why basic math is destroying your financial future. It's probably a little aggressive. Like, I don't think, we're not destroying financial futures. When you see the returns that these numbers, that the data shows, I'm going to make the case it's much worse than projected. I mean, I don't even need to make the case. It's just it's black and white. The math is real, and I'm going to prove it here. That any financial planners using this metric are objectively wrong, but destroying is not the right word, because you can still turn money into a lot more money, just not at the degree that it's shown. So take that with a grain of salt. But all right, let's see here. There we go. All right. The myth of the perfect parabola. Just put it in the market and expect a 12% average return. If you're listening, I've got this great looking slideshow. You can watch on the YouTube here, but the average 12% rate of return. And so they're going to look back and say, here's what the market did for this 30-year snippet. The market average is X. So here's what we're going to use as our assumption as we plan for the future. So we plan for the future using that 12% average rate of return. You see, you have this parabolic curve, this mountain of growth. It looks very nice, right? We love that. That's what we want to see. And that's what we do see when we go through this type of planning. All right, basic math is not financial math. And so the average rate of return, it's true. It's correct. It takes a snapshot of history and it takes an average. That's a simple mathematical function. They're not wrong when they say that this 30-year snippet averaged a return of 12% a year. That can be true. But math is not money. Money is not math. And so I'll call that the math. That's the average rate of return. But the money, what you actually see in your bank account, is very, very different. This idea of the average rate of return is practically useless for projecting your actual wealth into the future. Now, we all know past performance is not indicative of future, or past return is not indicative of future performance. We all know that's the case, but we plan as if it is the case, right? This inherently is like, they'll tell you that. They'll say past performance is not indicative of future performance, but then let's take past performance and apply it to the future, and we'll make our plans off of that. And I don't like that. So here's what I call the grift in action. So we start with $100, and we have 4 different data points here. So we're going to start with year 1, we have 100% gain. So we're up to $200. In year 2, we have a 50% loss. So we're back down to $100. In year 3, we have 100% gain. So we're up to $200. And in year 4, we have a 50% loss. So we're back to 100. So 100% up, 50% down. 100% up, 50% down. Those are 4 data points. And the average says we take 100 plus 100 plus negative 50 plus negative 50. That's equals 100 divided by 4 data points, 25% average rate of return. So if you just, I mean, this is very simplified, obviously, but if you just took this, you'd say, okay, well, over these 4 years, the market went up, the market went down. And look, the years that it went up by twice what it went down. We have 2 years of 100% growth and then 2 years of only 50% loss, right? Well, your actual return here, you stayed flat. After 4 years, you have exactly how much you had before, $100. Your 100 doubled to 200, then it was cut in half. Then it doubled, then it was cut in half. So your gains are 100%, but a return, or a negative year of half of that amount was equal in performance. Like that should be a red flag to us that, 100% gain is not the same as 100% loss. Like one of those is much more catastrophic. And so you could even get simpler here. We could just say 100% gain in year 1, 100% loss in year 2. And we have no money now. We've lost all of our money, but the average rate of return is 0. So this already should become very clear. And when I was working through this, I made like 4 or 5 instances. I trimmed them out of the PowerPoint because it just got repetitive. But you can take any 4 data points to come up with an average rate of return, and then you take a starting amount of money, run it through those 4 data points, and what the average says is never, ever, ever what the reality actual says, where your money actually ends up over that 4-year period. So the gravity of negative numbers here, this kind of shows, I don't quite understand what it was trying to imply here, but it takes 100% return to make up for a 50% loss. That's kind of saying what we did in the reverse order before. Before, we had $100. We had a 100% rate of return, so we're up to 200. And then we had a 50% loss, so we dropped back down to where we were before. We cut in half, now we're back at $100. But if you take a 50% loss in 1 year, as another data point here, it would take 7 years of 10% gains to get back to where you were before, to get back to even. So the power of a negative number when we're talking about compounding is masked by the average rate of return. And so we'll play this out a little bit further. And so here's the source that I used in that article. I used the Dave Ramsey article, The Truth About the 12% Returns and Simple Averages. So it goes into it and it says, yes, the market goes up, the market goes down, but what matters is that over the long run, the market averages 12%. And so how do we get those numbers? And I followed all the links that they provided. And the number said, yeah, here's this 30-year data point, 1990 to 2020. Here's 30 years of S&P 500 returns. And so you're correct. It was a 12% average rate of return. You add up all the returns together, divided by 30, you got the 12%. It's like 11.9, something like that. But the number that they use correct math here. So the math is not wrong, but the money is wrong. And so, spoiler up front here, like we'll show this, but spoiler up front, the mainstream claim is that if you start with, say, $100,000 and you don't add anything to it, those are the assumptions we're making. We're taking 30 years, we're taking $100,000, we're adding no money to it, and we're taking that claimed average rate of return. Okay, here you can see it's 11.45. So the title headline said 12, and again, this is all pulled exactly from that website. The title headline said 12%, but then they clarify 11.45% was the actual rate of return. We're just rounding it to 12, which I guess whatever doesn't really change the reality here. So 11.45% rate of return on 100 grand over 30 years. You would have 2.585 million, right? $2,585,000. Every single year it goes up, you get 11.4% return on your money. And so those last years down the road, you're just making so much money, right? Because every year builds on the last one. You have that kind of flat period there for a while, but then it really hockey sticks upwards. Now, let's look what actually happened on those same exact 30-year snippets. So we start in 1990 and we take $100,000 and we say, okay, what actually happened in year 1 in 1990? Okay, here's our new balance after that year. Okay, take the new balance. What happened in 1991? Okay, here's our new balance after we apply what actually happened in 1991. Take that 1991 balance, what happened after we apply what happened in 1992, and so on. We do 30 actual monetary transactions where we take our starting balance, apply the change there, apply that year's return, and get an ending balance that we then carry over to the next year. What that means is that when we have those negative balances, they negatively impact our principal. And so in that, going back to our very simple example, if we have a 50% loss in 1 year and then a 50% gain the next year, you might think based on averages that we zeroed out, but we didn't, right? Because $100,000, if year one you had that 50% loss, now you're down to $50,000. And in year two, you have your plus 50%. 50% of $50,000 is 25. And so we add that, now we're at 75. So our average rate of return said we stayed even, plus 50, minus 50, plus 50. Average of that is 0. But our actual return is we lost 25%. Like, so you can't basically kind of math out, fade away the numbers with math when you're using this actual compounding returns. I hope this makes sense, but you can see here, we go from having just shy of $2.6 million, that's 2.585, $2.6 million. And when it's all said and done, when we take what actually happened in the past and we use actual market data and take an actual starting amount of $100,000 and let it flow through and let it just get carried by the market up and down for 30 years, we end up with $1.72 million. That's a big shortfall there. It's not quite $1 million, but it's coming up on 850,000 or so of a shortfall that you would have if you were relying on this 2.585 and you have 1.7. Well, expanding that out into the CFP mindset. Well, if we're making our 4% safe withdrawal rate calculation based on $2.58 million, well, now we're at 1.7. We just greatly impacted our standard of living here. We're gonna have to either withdraw more than 4%. Or we're going to have to keep working longer or do something else to supplement that. Again, this is taking this in a vacuum. This is taking this one data point in isolation. But whatever we're trying to do with this money, we fell pretty far short, about close to 30% shy of where we thought we were going to be. With perfect hindsight information, that's the main key here. So I call it grifter math, and I don't think that's being too harsh. I really think that if you use the average rate of return to project into the future, I really think that can accurately be labeled as grifter math, because you are going against the thing you very likely just told your client, which is that this doesn't indicate future performance. So there it is. You can see the actual returns plotted there. I mean, kind of loosely plotted, but at the end of the day, instead of the 2.5 million, you have 1.7 million. So even with only 6 down years in those 3 decades, 6 down years, we fell 34% shy of our promised return. Again, not promised, because it's not, they'll never make that promise, but they will show you this chart. And I think if you're not going to show this, I think if you're going to show this chart, you need to be a lot more clear on the implications of this and the actual math. Hey, here's the data set we used to derive this 11.45% rate of return. Here's the actual historical numbers that we're going to use and translate that forward. But if you're going to do that, you owe it to them to say, but in reality, that these 30 data points would not have given you the return we're showing you right here. And no one's ever going to do that, because if I see this, if I'm in this conversation as a client, if I understand this, if I'm presented with this, I say, well, why would you even show me that? To me, it's a useless data point. It's like, I'm not just going to be like, okay, cool, I get it. So you're going to show me $2.6 million, but in reality, if it goes exactly as it went, I would have 1.7, right? I'm hoping for 2.6, but if it goes as accurately predicted, or if it was exactly as predicted, if we have hindsight and perfect information, my 2.6 becomes 1.7. That doesn't fly with me. And so everything else you say, whether other things you say are true or not, like nothing else matters that you could say. Like, you have no value to me as a client if you're going to show me something that the math, the numbers which derive the math itself don't hold up. Like, I'm close to $857,000 shy. Like, I'm not going to accept that. And so here's a graph that it created, and it's just said, what if you started late? So if there's a certain period of time, and this shows the .com crash and the housing crash, if you went through those, because of 2 major market events, the actual annualized return over 2 decades was 5.62%. And that goes from 2000 to 2020 over that same time period, right? Again, take none of this as don't invest in the market. The market is ripping right now. And so if you've been in the market for the last 5 years, you are crushing it. If you've been in the market since 2008, phenomenal, right? I hope you can touch that soon. I hope you don't have to wait another 30 years to see anything from that, because, but what this is more just to highlight, the takeaway listed here: sequence of returns and life events dictate your wealth, not long-term averages. I want to make the point here that average rate of return is meaningless and should be ignored. And if it's presented to you, just end your working relationship with that advisor, because it's just a bogus number. Now, let's add a little bit more to that. Let's make it even less appealing. because here's numbers, and I'm going to show like actual. I'm being conservative here, but if you're seeing, it's called the erosion of the castle. If you're just listening, and you see 4 bars here. The first one is our $2.58 million. That's our that's our projected 11.45% average return, right? That's the one number you're going to actually see. The other 3 bars here is the adjustment after market reality, i.e. 30 years of data got us this average. They would actually get us $1.7 million, even though we're going to show you 2.6. But then we have 2 more here. So we take a big haircut, 30% haircut or so on the actual math. And then we have 2 more haircuts we're going to take. One is the assets under management fee. I assumed 0.5%. I mean, 1% is standard. And I've been at conferences and I've been told, hey, you got to get in the AUM business. I know you're doing your whole life thing, and whole life it pays pretty well, but like the real money is in AUM. Like the real money is in getting a percentage every single year. We get paid on a whole life policy. Like I get paid on year 1. I don't get paid a fixed percentage of every year, including all the growth forever, right? And so that's the pitch with AUM. It's like, hey, it's easy. If you get $1 million assets under management and you just take a 1% fee, like that's a good income right there. And $1 million is not too hard to get for assets under management if you have a decent client base. And so we've been pitched that before, but I'm being conservative here. 1% is pretty standard. I'm saying 0.5% ongoing management fee. Now we've dropped from 2.6 with the math, but not actually the money. So the money would say 1.7. So we're down to 1.7 million. And then after a 0.5% AUM fee, we're down to 1.48. That's about like $250,000, $250,000 in AUM fees. If it's 1 million, you can typically take about a third and make that the haircut, because over 30 years, 1% a year, that 1% that you're not getting is going to compound as well. When we're talking kind of a hypothetical or a counterfactual here. So it eats into that $2.6 million. It's not like you're actually losing that money. You lose that 1%, but that 1% was going to grow and compound over 30 years towards this $2.6 million, the mythical average rate of return number, right? And so that's another haircut we're taking there when we shave off the AUM fees. And finally, we're going to shave off taxes. So this is a 20%. I'm trying to be very conservative with this, but I said if you pay 20% taxes on this account, and we paid, that's the other assumption we have to make, is we pay taxes out of the account. Now, a little like inside baseball here. When you see that projection and they say, again, they're going to show you the 2.6 number, you should now know, actually, the very number that you used to get 2.6 would say we're going to get 1.7. So don't show me 2.6. Show me 1.7, what those numbers actually indicate we would get. But 2, they'll say, okay, well, here's the management fees. We'll do 0.5%. So $1.5 million. We turn 100,000 into $1.5 million. That's not bad at all. No one's, I'm not going to sneeze at that. But then they're going to say taxes are not included, paid out of this account. So this account gets to grow without paying the tax hit. Those taxes have to come out of somewhere. You're going to have an opportunity cost when you're paying that tax bill. If you pay it out of this account, your return drops to $732,000. If you're in the 20% tax bracket, that's pretty conservative in my mind. Hopefully a lot of clients, if you're looking at $2.6 million, like if that's the kind of returns you're looking at, hopefully you're in a higher tax bracket than 20%. Not that we love taxes. I think it's our duty to pay as few taxes as possible. It's our patriotic duty to starve the government. But we have to make the assumption, I think it's better planning to plan taxes are coming out of here, out of this account, rather than the opportunity cost of them coming out of somewhere else. But regardless, we go from 2.6 million down to 700,000, 732,000. That's when we factor in, we start with the math, which says 2.6, and then we go with the money, the actual reality, 1.7. AUM fees, 1.48. Taxes, we're down to 0.7, 732,000. You're about 28% of what that initial chart showed you. The summary here is you only get one shot at this. And so, again, I said this data point's isolated in a vacuum. If you're making your decisions on having 2.6 in retirement and you end up with 1.7, your 4% withdrawal rate is not going to work, right? And so I think that alone should be enough that if you ever hear that, to me, average rate of return is a red flag. If your advisor is talking about the average rate of return and then using that to project in the future, you can safely walk away, honestly, in my opinion. It's not financial advice. For some reason, I have to say that. But I would walk away from a financial advisor who's using average rate of return unless they're very explicit in the actual rate of return, the actual compounding rate of return derived from the same numbers that got me the average show this. And if we're going to plan off of that 1.7, well, then, hey, that's doing your, that's doing your fiduciary duty. And then you should show the fees coming out of that and then the taxes. But again, you don't even need the fees and taxes to show how destructive planning off of an average rate of return could be. You only get one shot of this. If it doesn't work, like, you have to go back to work. You can't get that time back. And so I want us to remove this uncertainty from the bulk of our cash flow. And we prioritize cash flow over net worth. I want cash flow in quote retirement. I don't want a high net worth. I want cash flow and I want guarantees. I want some risk and I want some speculation. I want those market returns, but I want the cash flow first and foremost. And so if you don't get there and you end up 30-40% shy because the math went exactly as the numbers said, again, I just can't hammer that enough. That situation where your projected 2.6 ended up with 1.7 was exactly right. That's if everything went perfect. That's if you got those numbers that got you that 12% or 11.45% rate of return. If you got those exact numbers and everything went right, you ended up with $1.7 million. You ended up in the best case, $850,000 shy, right? And so please just take that data. If you don't throw that data point out entirely, take it with a grain of salt. So we don't want mathematically flawed speculation. We don't want to hope for averages, crossing our fingers through downturns, ignoring the gravity that a loss will have. We want certainty and guarantees. And so I'm not even really trying to tie this into how we position and use whole life. Like, there's nowhere else where you can get this where you can get this guaranteed compounding growth other than your whole life cash value. That's a contractual certainty. It has nothing to do with the market, right? If I have, like everywhere else that I look at, even the high yield savings account, those rates are going to change. Now that's safe, that's liquid, but those rates are going to change. And so I can't really plan off of that. It's a good place to put money, better than just a basic savings account. But right now, like MicroStrategy, their preferred shares are given 11 point something percent annually right now. And so that's better. But again, like that, the stock price fluctuates, the yield changes based on the actual market, the market price relative to par. Without getting into any of that, like, those are fine places to store capital. But if we want guarantees, if someone's telling you the power of compounding and they're saying this, they're showing you positive, uninterrupted compounding growth, well, they can really only be showing you cash value. Otherwise, they're speculating. And so this is not the place for speculation. Now, I'm not trying to blur the lines of saving and investing here and saying, hey, instead of investing, save your money into a whole life policy. I'm not trying to make that case here, because that's not the case we would make. We would say build your savings foundation, and if you want actual guaranteed positive compounding growth, this is where you can do it. Now, not to the degree, you're not getting 11, 12% average rate of return here. You can get an average rate of return without those down years where that average actually matches reality, where your best case is the exact case you're going to get, because we're talking contractually again here. But like when we're talking about our rate of return internal to a policy, it's generally in the ballpark of 4 to 5%. But taking that guarantee with no down years in our savings is very powerful. If I could take an investment that guaranteed 5% with never any downturns, always it was going to be 5%, that's a very strong play. And I like that compounding for down the road especially. But again, you're only going to find that in cash value. But still, it's not the point to just say, don't invest, just save in a whole life policy. But just understand, guaranteed compounding only happens here. It doesn't happen in the buckets and the assets that you're looking at with your financial advisor. So this and asset strategy, to borrow Caleb Williams, the title of his book, The And Asset, you're talking about guarantees, collateralization, private money efficiency. Again, this gets back into the IBC element of it, which is really not my point here today. I think when you understand this and as a foundational component, it is a very strong argument for it. But again, not what I'm trying to do today. Stop being a passenger in your family's financial future. That's our tagline there. And take back control of your wealth. So let's deal uncertainty. This is the slide deck that it created. It says you can book your strategy session. We're not going to put this out, this specific PowerPoint. Obviously, you know how to schedule with us. I'm going to stop sharing this one, and I'm going to share one more thing, just another product, because it was cool just playing with it and see how much better it did than I did. But here's the same thing. What we're looking at here is the same data, and I saw the same thing that made the slide deck. I just said, make it a one-page infographic. So you can see the same thing here. And this actually shows it a little better, where this charts the actual returns using those data points from the Dave Ramsey article. And you can see how we got that gap there between our final return and our targeted balance there. Now their numbers are slightly different here because this takes the 11.4%, and the other one said the 12%. But the point is, you're about 30% shy in reality. And something that I did, and I didn't show on here, but something I did was I took every 30-year snippet of the S&P 500 because I'm a nerd. I took every single 30-year snippet, and I took the average of all of those. And so of all of the 30-year snippets of the S&P 500, take the average, you can't find a single snippet where the actual final balance in compounding, the real money you would have using that same metric. Again, the assumptions made are $100,000, no additional contributions, and taking the average rate of return of those 30 data points compared to the actual experience of $100,000 traveling through that 30-year window of time. You cannot find a single 30-year window where your returns got anywhere near, they're all about a third shy of your projected, average rate of return numbers. And so it's a faulty metric that you should have no reliance on, in my opinion. And I think that if you're still with us, if you're still listening to us, I think most people understand that because we don't have this conversation much anymore. And really, the more uncertain people get, the more people crave certainty. So right now, it's very tempting. Like, you're like, man, I'm missing all these gains, so I just get in the market right now. But am I at a peak? It's very comforting, guys, to not have that feeling of worry, of anxiety, of FOMO, because I know where my guarantees are and what is building that future cash flow for me. I'm putting it in contract wealth. I'm putting it in guarantees, not statement wealth, not projections. And so it's a very comforting way to be, even though I've missed out. I could have a higher net worth right now had I allocated all my capital towards the market. I definitely recognize that. But I want low stress, and I want certainty, and I want guarantees. And if I can achieve that and have the life I want, I would rather have that than be stressing about the market. And is AI in a bubble? I think the answer is yes and no, as I explained earlier. And we'll see how the rest of the year plays out. But I expect that it's going to be a very bumpy ride for a couple of years. And that could look like the stock market continuing to climb while everything else appears to crumble. So we'll see. But I'm going to stop sharing this. There's a couple more things on here. This just shows, it's kind of trying to show 150% loss takes 7 years at 10% to return. It says average is the wrong metric. I think that's very true. So foot stomper. With perfect, precise hindsight data, taking those exact same data points and applying them to the future, still falls 30% shy of what the average return would tell you. So I'm happy to have that conversation. If you want to discuss it on a call, I can walk you through more examples here. And I can show you how and what we do, and we're putting in this savings foundation in place, how we can actually achieve that perfect compounding growth. But that again, that doesn't even need to be a part of this. Like these numbers just speak for themselves. And so hopefully that makes sense. If you're listening and you want to see the visuals, hop on YouTube. If you're not already subscribed to YouTube, we'd appreciate it. It helps us out, and we want to get to that threshold where we can actually control the ads instead of you being forced to listen to whatever trash is on there right now. So anyways, all right, hope that helps, and I hope that kind of sharpens your sword when you're thinking through your role as the CFO of your family, because you need to take that role and stop outsourcing it. Stop being a passenger in your family's financial future. All right. Cheers, y'all. See you next time.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.